is the utilities Select Sector SPDR ETF, better known by its ticker XLU, flashing major sell signals right now? I mean, is it facing a falling trend?
Or, is it secretly a strong buy, even though it's hovering right near its all-time highs? Like, is it somehow still undervalued?
Yeah, or honestly worse, if you buy in today, are you just stepping blindly into this massive value trap?
Right. It is arguably the most complex puzzle in the markets right now
Yeah,
because we're looking at these wildly conflicting signals in an asset class that, most investors usually just ignore.
exactly, because it's supposed to be safe and predictable and, frankly, a bit boring.
Yeah, definitely boring, usually.
Welcome to today's deep dive where we are going to, tear apart those conflicting signals and see what is really happening under the surface. But before we unravel the sources and get into the data, we have a quick favor to ask you.
Just a small one.
Right. Please like this video, subscribe to our YouTube channel, and leave your feedback in the comments. We actually read them. And honestly, hearing your perspective on this one is basically compulsory for us to keep making these deep dives.
For sure. And as a quick reminder before we get into the actual numbers, this conversation is just a natural human debate. We're exploring the data we have in front of us.
Right. We're analyzing the trends, the fundamentals, the technical.
Exactly. But absolutely no financial advice is being given here. Always do your own research.
Always. Okay, so let's lay out the mission for today. We are pulling apart the financials, the technical analysis, and the latest news surrounding XLU.
Which is super interesting right now.
It really is. So as of mid-April 2026, the fund is trading right around $46.47.
Give or take a few cents, yeah.
Right. And our goal is to figure out if retail traders are getting lured into a trap right now, or if they're finding a genuine golden opportunity.
And to do that, we really need to understand why a traditionally sleepy sector is suddenly acting like a high-growth tech stock.
Yeah, because XLU is up like over 9% year to date.
Which is massive for utilities.
It is. And the 52-week range, it's $37.52 at the low end, all the way up to $47.80.
Right, so we are sitting dangerously close to the absolute ceiling right now.
Exactly. So why is there this massive bullish trend for power companies? I always thought of utility stocks as the slow, steady tortoises of the market.
The boring tortoise, yeah.
Right. You buy them, you collect your dividend, you hold them forever, and they barely move. But looking at these price charts, it feels like this AI infrastructure boom has essentially strapped a jetpack to the tortoise.
I love that. The jetpack analogy works perfectly. But let's look at the actual mechanics of why that is happening.
Okay, lay it out for us.
So artificial intelligence does not just run on cloud servers. I mean, it runs on unprecedented amounts of electricity.
Right, power.
Exactly. When you run a generative AI query, it requires significantly more computational power, and therefore electricity, than like a standard internet search.
Like way more.
Way, way more. So tech firms are realizing they cannot build these massive AI data centers without a guaranteed, just massive supply of power.
So they are going directly to the utility companies.
They have to. They're being forced into these very lucrative, long-term power purchase agreements. And this transforms utility companies from being static providers of residential electricity into critical infrastructure partners in the tech revolution.
Wow.
Yeah, the tech giants simply cannot operate without the product these utility companies are generating.
So if AI is the fuel for this sector, I want to look under the hood at the financials to see if this specific ETF has the engine to handle it.
Let's do it.
Because the numbers in our research are staggering. I mean, XLU has $25.16 billion in assets under management. Yeah, and that number is up 4.5% just in the last month alone. What does a massive jump in assets like that actually tell us about the broader market?
Well, it tells us that institutional money is rotating heavily into this sector.
Really? Just based on 1 month?
Well, think about it. A 4.5% monthly increase in a $25 billion fund is not retail traders buying a few shares on their phones, right?
Good point.
That is large-scale capital positioning itself for a long-term narrative.
And the 1-year window backs that up completely. We are looking at net inflows between $4.08 billion and $4.27 billion.
People are just pouring money in.
They really are. And looking at the balance sheet, it seems incredibly stable. The fund's liabilities are sitting around $194.09 million.
Right.
And they have $57.16 million in net cash as of mid-April. Plus, if you're trading this, the expense ratio is a tiny 0.08%.
Super cheap.
So it's very cheap to hold. And it still pays that classic utility dividend, like
Right.
a 2.59% trailing 12-month yield or forward yield of 2.67, with the latest payout being 31 cents per share.
Which is, the traditional appeal of a utility fund. You hold it for that steady income.
But I have a major hang-up here when I look at the
How's the
valuation.
TE ratio?
Yeah. The research shows a price-to-earnings ratio sitting somewhere between 19.1 times and 23.3 times earnings.
It's high.
It's really high. I know enough to know that paying 20 times earnings for a software company makes sense because they can scale infinitely.
Sure.
But for a group of companies that literally have to lay physical copper wire and build physical power plants.
It's a completely different ballgame.
Exactly. So are we looking at a truly undervalued asset because everyone believes this new 12% annual earnings growth forecast? Or is this a classic value trap where people are overpaying for a boring company disguised as a tech stock?
You are hitting on the exact debate happening on Wall Street right now.
It's confusing.
It really is.
Yeah.
To understand the PE ratio here, you have to look at the historical context. Traditionally, utility stocks trade at a much lower multiple, maybe like 14 or 15 times earnings.
Right.
And the reason is exactly what you just pointed out. They are highly regulated, capital-intensive businesses with slow, capped growth. So paying 23 times earnings means investors are aggressively pricing in that forecasted 12% growth.
So the market is essentially prepaying for the AI revenue before the power plants are even built.
That is the risk. That's exactly it. The value trap argument rests entirely on whether that 12% growth actually materializes.
Wow.
Yeah, if the long-term AI power agreements hold up and deliver that revenue, then a 20-plus PE is justified. Take a sector heavyweight in the fund like Duke Energy.
Okay.
Analysts are looking at their upcoming projects and actually raising their price targets to the $142 to $143 range.
Which is a big jump.
It is. But if the tech sector pulls back on data center expansion, or if the infrastructure just costs too much to build, then earnings will miss the mark. And suddenly, investors are holding an overpriced utility stock.
Ouch. That makes the fundamental picture pretty clear, I guess. The stock is priced for a perfect future.
Perfectly said.
But let's look at the technical analysis because the charts tell us what traders are actually doing with their money today.
And the data gets really messy here.
Incredibly messy. I mean, the long-term trend is obviously bullish. XLU is trading at 46.47, which is sitting comfortably above its 200-day moving average.
And just to clarify for anyone who might be new to that term, the 200-day moving average is a widely used technical indicator. It basically smooths out the daily price fluctuations to show the long-term trend.
Right.
So the fact that the price is well above that average,
Yeah.
which is down around 43.50 roughly, confirms the overall upward momentum.
Okay, so the sources show an immediate support floor at 45.15 and resistance at the ceiling near 47.60. But I'm looking at the momentum signals, and they're completely contradicting each other.
Yeah, it's wild.
Analysts are giving XLU an aggregate strong buy rating, but then we have the 14-day RSI, the Relative Strength Index. Can you explain what that's actually measuring? Because it's bouncing everywhere between 46.89, which the notes call neutral, all the way up to almost 71.
Which is screaming overbought,
Exactly.
right? So think of the relative strength index like the RPM gauge in a car.
Okay.
It measures the speed and magnitude of recent price changes on a scale from 0 to 100.
So higher means faster.
Exactly. When the RSI gets above 70, the engine is revving incredibly high. It means the stock has been bought up so fast that it might be due for a cool down or, a pullback.
So the analysts say strong buy based on the long-term AI story, but the RSI is saying the engine is overheating right now.
Yeah.
And it gets even more complicated. The MASTI indicator gave a buy signal earlier in the month, but now shows a slight negative lag of like negative 0.09.
It's all over the place.
How does a retail trader even begin to navigate these conflicting timeframes without buying at the absolute top?
Well, the danger here is trying to time a multi-year structural shift using short-term trading indicators.
Oh, that makes sense.
Yeah, the moving averages and the strong buy ratings are looking at the macro picture. But for someone looking at the next 2 weeks, the technicals show a massive red flag.
Okay, what is the specific red flag?
It's an indicator called the stochastic oscillator.
The what?
The stochastic oscillator. And without getting too deep into the mathematical formula, it compares a stock's closing price to its price range over a specific period.
Gotcha.
Right now, this oscillator is actively exiting the overbought zone. And when we look at historical data for this specific technical setup on XLU, that movement carries an 82% probability of a short-term pullback.
Wait,
Yeah,
82%?
82.
An 82% probability is massive. It feels like throwing a ball into the air. Even while the ball is technically still moving upward, the upward force is weakening right before it hits the peak and drops.
That is the perfect way to visualize momentum exhaustion. The price hasn't necessarily collapsed yet, but the force pushing it higher is fading rapidly.
Wow. Well, if the upward force is fading and there's an 82% chance of a pullback, that makes me wonder who is placing bets against the ETF right now.
Right.
Because looking at the order flow, the options market is telling a very cautious story.
It is flashing some significant warning signs for sure,
Yeah, the sources highlight an outsized put-call ratio of 2.7.
which is huge.
Super high.
Yeah.
For anyone unfamiliar, a put option is a contract that gains value if the stock goes down, and a call option gains value if it goes up.
Right.
So a ratio of 2.7 means that nearly 3 times as many people are buying puts to protect against a drop compared to those buying calls.
Yeah.
There are 1.3 million put contracts open right now.
It's a lot of puts.
It's insane. And we're also seeing insider selling in top holdings, like Duke Energy.
Yeah.
The sources note these are tax-related dispositions, but still, insiders are selling shares near the top. It feels like watching someone buy a massive amount of hurricane insurance right after they finish a multi-million-dollar renovation on their house.
That's a great way to put
The
it.
house looks beautiful, the AI expansion is underway, but are the big players quietly preparing for a severe storm?
We have to be careful not to misinterpret that options data, though. A put-call ratio of 2.7 is extraordinarily high, but it does not necessarily mean institutional investors are panicking or actively shorting the stock, expecting it to crash.
So why buy 1.3 million contracts, betting it will go down?
It comes back to hedging. When a fund is hovering near a 52-week high, institutional managers are sitting on significant profits. I mean, the year-to-date gain is over 9%.
True.
To a massive fund, buying put options is exactly like your hurricane insurance analogy.
Yeah.
You don't buy the insurance because you want the house to burn down, or even because you expect it to. You buy it because you have something highly valuable to protect.
That makes total sense.
It is a totally rational move to lock in gains just in case the technical weakness we saw earlier actually triggers a sell-off.
But what actually causes the storm? If the AI demand is virtually guaranteed, what macroeconomic factors could realistically drag this sector down?
The single biggest headwind for utilities is high interest rates. As we discussed earlier, this is an incredibly capital-intensive sector.
Yeah.
To build the grid infrastructure required by these AI data centers,
Yeah.
utility companies cannot just use the cash they have on hand. They have to borrow billions of dollars in the bond market.
And when interest rates are high, the cost to borrow that money skyrocket.
Precisely. The cost of servicing that new debt eats directly into the 12% earnings growth forecast.
Ouch.
If the Federal Reserve keeps interest rates elevated longer than the market expects, the profit margins for these utilities will shrink, regardless of how much power the tech companies buy. Additionally, high interest rates make the utilities dividend less attractive. I mean, why would an investor take on the risk of holding a stock for a 2.6% dividend if they can get a guaranteed 5% yield from a risk-free government bond?
So the macro environment is directly fighting the micro AI catalyst.
Yes, exactly.
The structural demand is pushing the stock up, but the cost of capital is weighing it down.
It's a tug of war.
And the sources also mention geopolitical volatility as a risk factor, specifically pointing to the conflict in Iran.
Geopolitics play a massive role in utilities because they impact the global energy supply chain. Any escalation in the Middle East tends to drive up the cost of oil and natural gas.
Oh, right.
And since many utilities still rely on natural gas to generate power, a spike in raw energy costs squeezes their margins even further.
That makes sense.
It creates a volatile environment where holding a utility stock at a high 23 PE multiple suddenly feels very uncomfortable for an institutional manager.
So we have all these forces colliding. We have a once-in-a-generation surge in demand from AI, fighting against heavy options hedging, high borrowing costs, and global energy risks.
It's a lot to weigh.
Let's synthesize all of this and map out the actual scenarios for the listener. Based on the data, what does the definitive bull case look like?
Okay, the best case scenario is a bullish continuation. For this to happen, the price needs to break above the key resistance ceiling we mentioned earlier. specifically pushing past the pivot highs near 47.21.
And what drives that breakout?
It relies on the market completely shrugging off the short-term technical weakness.
Okay.
In this scenario, the relentless demand from AI infrastructure, combined with the $1.6 billion in fresh net inflows we have seen over just the last 3 months, overpowers the macro headwinds.
So investors just ignore the interest rates?
Essentially, yes. Investors decide that the growth is so guaranteed that the high interest rates don't matter. The stock breaks resistance and sets new all-time highs.
Okay, but then there's the bear case. The worst case continuation lower. What triggers that?
The bear case is triggered if the stock breaks decisively below the pivot low support.
Yeah.
So we're talking dropping from 45.88 down through 45.15. If it drops below that level, the technical charts break down and things could get ugly.
And the fundamental catalyst for that drop is essentially everything we just discussed coalescing at once.
Exactly.
Sustained high interest rates crush their borrowing power, global instability spikes their fuel costs, and retail traders panic and sell when that 82% probability stochastic pullback finally hits.
Right. And it highlights a critical distinction about timelines here. When you evaluate the bull and the bear cases, they aren't actually mutually exclusive if you look at them across different time horizons.
Wait, how do you mean?
Well, the short-term outlook is incredibly fraught with risk. You have technical momentum fading, you have 1.3 million put contracts acting as a psychological weight on the market, and you have macroeconomic uncertainty. Over the next few weeks or even months, volatility is the baseline expectation. But the long-term perspective, it remains entirely anchored to the structural shift in power demand.
The AI story.
Right. The AI data centers are going to be built, and the grid has to be modernized, regardless of what the stochastic oscillator or the MACD says today.
Wow. So we are looking at a utility fund that is currently operating with the wild volatility and the sky-high expectations of a tech-adjacent growth stock.
Yeah, that's exactly what it is.
It is totally caught in the crossfire. On one side, you have explosive, historic demand from the tech sector forcing a modernization of the grid. And on the other side, you have severe technical gravity, expensive debt, and harsh macroeconomic realities.
It is the ultimate clash between a visionary technological future and a very, very expensive financial present.
That tension is exactly what makes this specific asset so fascinating right now. And we are going to leave you with one final thought to mull over, something that really gets to the core of this entire debate.
This is the big one.
If explosive AI growth requires a flawless, incredibly robust utility grid, but sustained high interest rates make upgrading that exact grid prohibitively expensive, who exactly blinks first? Is it the tech giants who are desperate for power and will have to subsidize the infrastructure, or is it the market that has to finance the debt?
That is the multi-billion-dollar question that will basically define this sector for the next decade.
It really is. Well, thank you so much for joining us on this deep dive. If you enjoyed the breakdown, please remember to like the video, subscribe to the channel, and drop your thoughts on that final question down in the comments.
We read every single one.
We do. We will catch you on the next deep dive.